We're here on Monday afternoon and we're seeing the major U.S. stock averages trade within a narrow range. Of course, we did get a reaction following the results from the French presidential election. But without further ado, I'm joined by Peter Cardillo of First Standard Financial, and he'll weigh in on what we've been seeing. Peter, good morning. Thanks for joining me.
Good to be back.
Well, of course, all focus this weekend was on the victory of French President-to-be, Emmanuel Macron. Now, given that a lot of the expectations were priced in ahead of the actual result, we didn't get that much of a reaction here in the U.S., although we saw the S&P and NASDAQ hit new record highs. But what do you expect to see going forward?
Yeah, indeed, you're right. A lot of this was already placed in the market, and so we saw that actually happen in Europe, where the markets were up substantially and then reversed course, and of course we followed. And I think another reason for a little bit of weakness today is the fact that we don't really have a lot of macro news, a lot of corporate earnings, but again, just a handful of any companies that would make a difference in terms of market action. So I just think it's a little profit-taking.
And Peter, indeed, we'll continue to keep an eye on economic data as well as developments out from France. As for the nation itself, the parliamentary votes will be coming in June, so that will be closely monitored. But given that we got that jobs report last week here in the U.S. and we've had some Fed speeches so far, what do you expect to see in terms of interest rates as well as a balance sheet?
Well, let's address the last week's labor report, and obviously it was good, and so it basically reversed that weak number that we had the previous month, and I think it certainly puts sentiment back on track that the jobs market remains very solid, and so that's the good news. In terms of going forward with interest rates, I do believe the Feds are going to raise in June. And I don't think that's any real secret for the market. If you track all the Fed speakers that we've had over the past 3 weeks, they all seem to indicate that we're going to have at least 3 rate hikes this year, possibly 4 if necessary.
And indeed, Peter, you do bring up a lot of important points there. Fed fund futures are pricing in a hike for the Fed June meeting. And historically, when we look at first quarter U.S. GDP, they do tend to be weaker than the rest of the year. And we'll take a look at those retail sales figures. But as we look ahead to this week, we also have the G7 finance ministers meeting. And of course, expectations at the end of this month turn to the OPEC meeting. So given where oil is trading right now, what do you expect to see?
Well, I don't think the G7 is going to offer very much. I think it's pretty much a foregone conclusion that unless we see further Chinese weakness in their economy, by the way, I'm referring to the trade deficit that obviously showed real weakness, then I don't think it's going to make much of a difference. So what we're seeing here is an imbalance where we see 1 week crude oil inventories come down, gasoline goes up, distillers does its own thing, and then the following week it reverses. But if you look at the numbers, they are much smaller in terms of increases, and so that's a key factor here. And oil prices crashed last week. I think part of that was due to the fact that Chinese demand fell off a cliff, and we saw that in the trade numbers today. So I think the fact that we held that 45 area, we're back into that 46 and a quarter, 46 and a half range, bodes well that we're probably going to see oil back around 50, 51 shortly.
Okay, Peter, well, we'll keep an eye on those inventory numbers coming out later this week. So as always, thank you so much for insight and analysis.
My pleasure.